What was the Glass-Steagall Act? Have you ever wondered how the banking system in the United States was shaped by major historical events? One key piece of legislation that played a vital role is the Glass-Steagall Act. This law, officially known as the Banking Act of 1933, was introduced in response to the banking crises and stock market crash that contributed to the Great Depression. Its main goal was to stabilize the banking system by creating a clear separation between commercial banking and investment banking. So, what exactly does that mean? Commercial banks are the institutions that accept deposits and make loans. They serve the everyday financial needs of individuals and businesses. On the other hand, investment banks deal with underwriting and trading securities like stocks and bonds, which can involve higher risks. Before the Glass-Steagall Act, many banks combined these functions. They used depositor funds to invest in risky securities, which led to numerous bank failures during the economic collapse. The Glass-Steagall Act changed that by imposing a strict division between commercial and investment banking. It prohibited commercial banks from engaging in investment banking activities, such as underwriting or dealing in non-governmental securities. Investment banks, in turn, were not allowed to take deposits. Banks had 1 year to decide whether to operate as commercial banks or investment banks. Additionally, commercial banks were limited to earning no more than 10% of their income from securities investments, with government-issued bonds as the only exceptions. Another significant aspect of the Act was the creation of the Federal Deposit Insurance Corporation. This organization provided federal insurance for bank deposits, which helped restore public confidence in the banking system. By protecting depositors from losses in case a bank failed, it aimed to maintain trust in the financial system. From a capitalism perspective, the Glass-Steagall Act sought to protect the essential principle of financial stability. By separating commercial and investment banking, it aimed to reduce conflicts of interest and the risk of bank failures due to speculative investments. This separation was crucial for safeguarding depositor funds and ensuring that credit continued to flow to businesses and consumers. The Glass-Steagall Act remained largely intact until the 1980s and 1990s. During this time, various provisions were gradually weakened and eventually repealed by legislation like the Gramm-Leach-Bliley Act of 1999. This repeal allowed commercial banks, investment banks, securities firms, and insurance companies to consolidate, reintroducing some of the risks that the Glass-Steagall Act had aimed to prevent. In essence, the Glass-Steagall Act was a regulatory response to the failures of the banking system during the Great Depression. It was designed to separate commercial banking from investment banking and protect depositors through federal insurance. This legislation reflected a capitalist approach that balances free market operations with necessary regulatory safeguards to maintain financial stability and protect consumers.